Warm greetings. This is Mark Boswell with Avitance Consulting and the Pastera Funds. And by this short presentation, I hope to introduce you to a novel new product that is positioned to take the market by storm as it relates to raising funds for projects and providing capital gains tax solutions for investors. Whether you may be a project developer or a registered investment advisor dealing with clients, you're going to want to know what's going on with this new product. This solves some very serious problems in an important way, and I think you'll find it interesting. Now, in each of these slides, you'll see an image in the left margin, and typically those are supporting documents. I'm not going to get into the supporting documents and drill down on those in this short presentation. I want to keep it as short as possible, give you a quick overview, and if this appeals to you in any way, we can schedule a follow-up session and drill down on those details as you like. Okay? So, welcome to the introduction of Qualified Tax Products, QTP. So let me tell you who this presentation is for and what it will do. On one hand, we have investment fiduciaries and wealth managers who want to provide custodial accounts. We also have money managers for our new funds having $50+ million per fund to manage and provide custodial services. On the other hand, we have business and joint venture partners who might be looking for funding for real estate projects like hotels, residential developments, office buildings, as well as master franchise owners wanting to expand their franchise network. Business development such as that. And of course, registered investment advisors who are dealing with clients solving capital gains tax problems. Okay? The QTP funds are new tax-deferred financial products for wealth advisors, and they're ready for the rollout phase. Here are some of the features and benefits. These products are, in essence, a qualified investment fund, issuing tax-deferred debentures, generally called bonds. You understand that? Bonds are issued through a patent-pending escrow process to investors wishing to avoid high taxes generated from the sale of valuable assets. The taxes are deferred by investment in a QTP product. Therefore, reinvesting the proceeds of sale of that asset in a long-term tax-deferred QTP fund is better than an annuity. And registered investment advisors sell a lot of annuities. So the net benefits over annuities are this. All right, the QTP products freeze capital gains taxes on any asset sales where annuities do not. It can compound tax-free, as does the annuity, but it has a lower tax rate in all aspects compared to an annuity. Investment management is top-rated, and we use fund managers like PIMCO, Allianz Global Investors, JP Morgan Asset Management, Loomis Sales & Company, Lazard Asset Managers. Okay? So the QTP financial industry has some momentum. All right, and here are some of the key features for investment professionals. All right, understand that the top industry leader called Source Media with 15 financial magazine publications. They have more than 2 million investment professional subscribers, and their publication, Financial Planning Magazine, they've committed to promote the QTP products via Industry Innovation Sessions, which is a specialized seminar presentation to qualified practitioners. Okay? They've committed to support us with magazine ads and articles on the benefits for an investor to choose a QTP product. And they've offered us a national rollout in 10 major cities with these industry innovation sessions, supporting ads, articles, and so forth. Okay? That's significant. So QTP builds investment advisor business quicker than any other investment product that they might sell today, and that happens for 3 reasons. One, investment product distributors who represent QTP investment funds want this product in order to obtain new clients who they could not reach before. All right, so this creates a new direct marketing channel to wealthy investors selling real estate and other types of investors and clients. On top of that, in addition to possibly increasing the book of business, this product could also earn the investment advisors another 48% in annual fees by selecting QTP products for their clients, which can increase their after-tax return by the same amount. Talking about the investor. So it's good for the advisors, it's good for the investors. It's good for everybody all the way around. All right, so this unique patent-pending financial process solves several problems. All right, one, it solves a serious tax dilemma for sellers who would be subject to large capital gains otherwise. It solves for the registered investment advisors and wealth managers, it solves having a stale book of business. And QTP is the best tool for advisors to build assets under management, much faster than with the traditional products that you're so used to. The QTP Pastera funds also provide commercial business opportunities through the finance partner members. What we're talking about here is that the funds, the capital in the funds, can then be used for commercial lending purposes. And this creates other commercial business activity. All right, so long-term investment with this program creates longer investment cycles, allowing the QTP's investment horizons to match the largest insurance companies because we use the same top money managers. And we've got greater flexibility to lend on all asset classes to help borrowers meet all their needs with one lender. Okay, so investors in the QTP are allowed to freeze their taxes upon purchase of a QTP bond, and it allows them to earn interest on the amount of the unpaid taxes, which again is the unrealized capital gains taxes they did not have to pay, that they would otherwise have had to pay. All right, so they're earning interest on that amount in their principal to earn the highest after-tax yields, comparatively speaking. Then, after 7 to 10 years of investment, the principal will grow sufficiently to offset the entire tax amount, which was frozen at the time of investment into the QTP bonds. All right, so basically it's a self-liquidating feature on that tax amount. That makes it interesting. The QTP investment fund custodians, managers, and contracted finance companies that are lending the QTP's funds function like investment banks, offering borrowers strategic business loans that require long-term vision for real growth. So you see how this fits together. It's a complete package. Now, qualified tax products are recognized in a financial industry innovation session, which we mentioned just a minute ago, with the biggest publishers in financial services like Financial Planning Magazine. QTP products have been recognized as the first to design this business model with a successful, non-obvious, but patentable subject matter. And hurdles cleared at the U.S. Patent Office, we're ready to build potential monopoly protections with patents. All right, so that leads us to virtually no competition, not only by virtue of the patents, but it's a new invention protected by anti-fraud rules that are basically streamlining a series of novel individual steps for investors, and it requires no material advisor relationship on the part of the investment advisors, which means it's simplified. The QTF offering memorandums cover the applicable tax code, which often reduces the need, the costs, or the delays incurred by the need for material advisors, the legal and accounting support, with safe, non-listed transactions that are not reportable to the IRS. Keeps things simple. And that helps move the velocity of business, right? This product is patentable. Financial products that are novel, like this is, and which streamline processes, are now patentable since 2001. We've got the market edge. It took QTP Financial Product Development roughly $5 million of research and development to create the proprietary method of investment and escrow processes, and we have more products to introduce. So we're ahead of everybody. Not only has this been researched and developed, but it's been proven. There have been 5 generations of test products doing real business and mortgage finance, putting this into practice already. There have been over 322 tested transactions with successful review of 8 different cases by the IRS at the field office level without further review. And tax-deferred transactions were recognized at that level without further discussion. That's huge. And speaking of huge, it's a huge tax savings. Investors may realize a savings of up to 48% of the principal amount of the assets invested in a QTF fund. And when you're talking multi-million-dollar properties, that is huge. Not only for the investor, but it's huge for the investment advisor when it comes to the base for his fees. More on that later. All right, so from innovation session to magazine ads to live events, QTPs have been seen and acknowledged already as the innovator by the financial industry. Okay? There's already a stamp of approval. So here's a simple example, just to look at the impact here. Sam is a California independent investment advisor with TD Ameritrade. He attended one of our 10 city tour events sponsored by Financial Planning Magazine and Source Media and decided to consider a Pastera fund for one of his clients, who is a California resident who inherited a small fishing property in the Sierra Mountains, which was valued at about $3.3 million. Now, if the property was sold and reinvested into an annuity, a mutual fund, or tax-exempt U.S. Treasury bonds with Sam, the advisor, the selling client is looking at about a $1 million tax bill. Not too small. The net investment would then be only $2.3 million from the original $3.3 sale price, all right, on which Sam earns 2% annually as his fee, right? With a new Pastera fund, they could do this. If Sam has then made the investment into a QTP product, the investor is qualified to receive a freeze on all taxes for as long as 30 years. We're talking about that $1 million. So the investor will be allowed to retain the $1 million otherwise paid in taxes by using the Pastera fund investment. And he earns interest for up to 30 years before any taxes are due. Simple math shows a 25% increase in the amount of interest he'll earn over the life of the investment. Plus, additional compounding of the interest will create the best after-tax return compared to any alternatives available through his investment advisor, Sam. So using the Pastera fund, the investor gains $1 million more principal, plus that interest is compounding faster. Sam, the advisor, his assets under management increase substantially as well, giving Sam an annual fee much higher than he would have had otherwise. So everybody's happy. It's win-win-win all the way around. All right, now, using industry-leading marketing channels for the Pastera rollout with media partners like Source Media and Financial Planning Magazine, we can see very rapid market adoption. Rollout to the market can be relatively quick. So direct channels through special events like Disrupt by Financial Planning, it's an event that they hold disrupt the market with new ideas and innovations. New direct channels and advisors advertising programs with real estate offices, business brokers, and affinity partners. Institutional exposure captures advisors' networks, entire networks at a time. So this is very significant. All right, now the USA and Latin America are ready. There are new SEC rules that are designed for the QTP products and just feed right into our hands. We can talk about these perhaps in a follow-up session so you can see how the rules apply to this product. The new tax bill, for example, has given us tremendous advantages for the QTP in 2018, 2019. And it provides new territorial tax provisions with foreign interest deductions to offset U.S. QTP fund income. Again, without getting into the details here, we can certainly do that with you in a follow-up session. But understand, one of the key elements is that the new tax bill in the United States for U.S. investors eliminates a huge tax exemption which had previously existed, which was the 1031 tax-free exchange exemption. When one property was exchanged for another property, there were no capital gains applied to that previously, but now there is. All right, personal property like commodities, gold, silver, cryptocurrencies, cattle, business equipment, artwork, they're all now subject to capital gains. All right, and this product is real simple to understand. Look at capital gains as a huge headache. It's a huge pain for taxpayers. All right, and the QTP product is the pain reliever that these people need to relieve that pain. It's very simple. Okay, so right now the economy is returning to its peak under Trump, and the timing could not be better. We're now entering the U.S. economy with this product when capital gains are at levels equal to or greater than what we saw in 2007, right before the economic crisis. All right, so the timing has never been better for this type of product. Okay, so who are the prospective Pastera Fund licensees? All right, the funds are intended to raise anywhere from $100 million to $500 million, generally speaking, okay? And the cost to sponsor one is about $2 to $3 million. That includes formation, initial startup, marketing costs. But in the regulations, the fund sponsor receives a special no-risk payback provided for in the regulations, which states that in the first 5 years, under the standard U.S. SEC, customary fund administration costs at startup are payable from the fund. Okay, so fund sponsors basically have a no-risk element under that regulation. Equity ownership in the funds would provide returns under U.S. tax-free portfolio S returns for foreign investors, with equity profit sharing possible with funds that are created by Latin American licensees. Okay, so again, I don't want to get too deep into the weeds here, but there are various elements to this which make it very attractive and interesting. Okay, so the typical profile of an investment group who would do something like this would be investment managers, trust fund managers, private family offices for wealthy persons, real estate investment companies and development groups, financial lenders seeking a pool of capital to expand their business, and of course, just wealthy individuals. Okay, so that's a quick rundown of some of the typical target markets that we'd be looking at. The development curve on this product is quite interesting because as we're looking at the rollout here in Latin America, there have already been 5 different generations of product prototypes that have been tested. and here are just a few. $2 million was raised to finance 2 small private companies in the early 2001 through 4. $1.6 million was generated for franchise expansion for the master franchise holder for Papa John's Pizza in Russia. $2 million was raised for a technology company expansion project that included some consultant e-tools developed for that company. And $6 million was raised to develop real estate projects. $3 million was raised in another venture for a commercial home renovation company. So this is not just an idea. This is proven, it has a track record, it has a history of development and success. So as it relates to rollout in Latin America, here's our vision of a timetable. All right, within the first 12 months, right now, we're looking for $350,000 initial seed capital to begin operations in Panama, Mexico, and Central America. Okay, once that's been set up, then next phase we look for a minimum of 1 venture partner to initiate the first fund, $2 to $4 million sponsorship, and we do that through the company that's being set up. Then within the next couple of years thereafter, we'd be looking for several fund equity partners to start using the Pastera funds in the United States. We could very easily have our own funds set up, as well as be licensing funds to clients. All right, and that would really come simultaneously, probably within the first 12 to 24 months. All right. So right now, the Panama company is authorized to manage loan portfolios on behalf of U.S.-based Pastera funds. Lending investment operations may be carried out by licensed offices specializing in local partners' expertise. And of course, those partners have yet to be determined. So based on what their expertise is, we can develop specialized activity for their business. That's what we're talking about, okay? So research, development, testing, and field application was phase 1. That's already completed. All right. Right now we're ready for phase 2. We're looking for the seed capital of $350,000 in exchange for 10% equity in the operating company to offer the licensing of Pastera Funds capital. And this will help us secure a phase 3 investment partner to get the first funds started. All right. The Panama company will target 2 Pastera fund sponsors and will generate $1 million licensing fee for each one. All right, so that's $2 million in revenue with those first 2 fund sponsors. The investor's principal or early exit strategy, if that's what he desires, we can be looking at an early exit strategy for a quicker turnaround or a longer term value proposition with equity and growth. But the early exit strategy may be triggered by the first sponsored Pastera fund reaching $10 million in U.S. bond sales and being in full operation. So the $350 that's being sought right now will be used for corporate and banking structure, establishing a market presence for Pastera funds with all the needed collateral marketing materials for this fund sponsors to acquire those fund sponsors. It will include market research and consulting on institutional and venture capital investors. In other words, identifying the best prospects for this product and working that market. It'll include expenses related to the raising of the working capital and the operational expenses for a year, and it will go towards purchasing the first level license with Avitance Global Consulting to be able to use the proprietary technology and put it to work in the marketplace. So the ideal investment partner that we seek right now would likely have some knowledge of capital gains, have some experience with that perhaps, and a knowledge of the financial markets to speed up that on-ramp process with the new company. He would understand the lending business related to companies in debt or equity ventures, may possibly qualify to be invited to the board of directors position in the Panama operation, depending on his or her personal preferences. All right, and certainly being bilingual in Spanish and English would be a big plus. For this new company, the target revenue, just to kind of put it into a visualization for you, looks like this. Year one, the company is set up, established, and moving forward, have one private fund in process of setup by the end of this year, 2018. All right, which would be $1 million licensing fee. Year two, we'd add 2 new funds to that. Year three, we'd add 2 new funds to that. And with a licensing fee for each fund is $1 million each. That's $5 million generated on the front end in the first 3 years. Okay. There's also back-end participation, equity participation in projects, and we can drill down into those details perhaps at another time. Okay, but that just gives you a good overview. All right, so the opportunity for the seed capital may depend on how active you might want to be, if you might be a prospect for that. That compensation may be adjusted depending on involvement, activity, and results that can be generated. Okay, obviously the offer is dependent upon a number of variables that will be determined in discussions, right? So a fixed cash-on-cash return could be had over either a fixed period or perhaps an event-triggered date. For example, the first QTF fund reaching $10 million in bond sales. In another project-focused investment, a future equity participation and profit sharing in a project financed in the future for the partner could be the desired compensation. So there's some flexibility there, depending on the needs of the parties that we might be talking to. All right. So assuming there might be agreement in the future, all right, the commitment process is real simple. All right, a simple letter of intent would open up an escrow. Funds would go into that escrow, and based on the business plan and mutual agreement, funds would be released for specific purposes to advance the project in accordance with the plan. All right, and then it's a simple matter of implementation. All right, very simple. So with that, I just thank you for your interest. If you've got further interest in getting some more details on some of this, we'd be happy to schedule another session with you and drill down on some of those details, show you some of the supporting documents, and dig a little deeper into this and get to know each other a little bit better. So with that, thank you very much for your attention, and we hope to speak with you again very soon.